Hi everyone. In this video, I am going to give kind of an overview of the financial statements that get included as part of the annual report. And I'm not actually going to cover every single financial statement that's in there, but I am going to cover kind of four main components that are expected of students to know at sort of an introductory level. So, first of all, here's your four main components. The income statement, the statement of shareholders' equity, the balance sheet, and the statement of cash flows. And so specifically, if we think about these statements, in a nutshell, the income statement is going to tell us about the profit and loss of the company. Okay, so profit, loss of company. The balance sheet is going to tell us about the company value, debt, and net value. So another way to think about that is in terms of the company value or its assets, the company's debt or its liabilities, and the company's net value or its shareholder equity. And then the statement of cash flows, which basically shows inflows and outflows of specifically cash. And then notice I skipped over one. I skipped over the statement of shareholders' equity, and that's because typically introductory accounting students are not expected to know that statement in its full detail. Instead, there's one piece of that statement that matters, and that is the retained earnings calculation. And so I'm just going to mark that here. The retained, misspelled that, earnings calculation. All right, now you may not understand all the terminology I used here. Like you may know what profit and loss is in general. You may not have any clue what retained earnings is. And you heard me mention asset, liability, equity. You may not necessarily know what those are. And don't worry about that now. I'm going to talk about those in a little bit more detail over the next few slides as we talk about each of these statements. But this is just kind of your high level. Here's what these four statements are going to do. And one of the key things to note is what I have written here at the bottom. Each one of these things is communicating a separate aspect of the business. Profit and loss is not the same thing as cash, right? Profit and loss is not the same thing as value, debt, and net value, and so forth and so on. So they're all communicating something separate. And yet at the same time, they're all connected. They do not necessarily stand alone. And you'll see that as we look through them, okay? So let's start off with the income statement. The income statement, as I've said, it's about profit and loss, and essentially it reports what's known as the results of operations for a specific period of time. Now, let me highlight that real quick for you. So, results of operations, and notice I have here revenues and expenses. In other words, what did you earn? What cost did you incur? That's the results of your operations. As you operate, you either earn something or you lose something. And so this is telling you the results of operations. And for a specific period of time. Now that phrase is very important because most financial statements do cover a period of time. It might be a quarter, it might be a year. The statement will specify what it covers. If we look over here on the left, I have an example pulled from Apple. Notice their income statement is not called income statement. It's called Consolidated Statement of Operations. And that's exactly right. You might see the word income statement or the phrase income statement at the top of these. You might see the statement of operations because that is another fair way to describe it. You might see statement of earnings. That would be another fair way to describe it. So not every company is going to use the phrase income statement, but they're all the same thing. Statement of operations, statement of earnings, income statement. You're all referring to the same document. Now notice here that at the top of the statement, it has the company name. It has the statement name, and notice it shows you the period covered. In this case, it says years ended, and then there's 3 columns because this is 3 years worth of data. This is the year ended September 28th, 2019, 2018, and 2017. And so that's the period of time covered by each of these columns, each representing 1 year of activity, 1 year of results of operations. And all financial statements across all companies, they're going to follow a similar pattern. You're going to see multiple years of data. The header of the column will tell you what year is being covered, or if it's quarterly, what quarter is being covered. So the income statement, the point of this statement is, one, tell investors what happened over this period of time, but two, provide them the trends needed year over year over year to help predict what will future operations look like. How are you doing? Have you changed something to make this better or worse? So forth and so on. So that's your income statement. Period of time, results of operations, helps investors predict kind of future results. The statement of shareholders' equity essentially tells you about changes that occurred in accounts that would typically be classified under the shareholders' equity section of the balance sheet. And so you might be thinking, well, wait a minute, but you're going to report the balance sheet, and that information is going to be on the balance sheet. But here's the thing. The balance sheet doesn't tell you about the changes that occurred. The balance sheet is actually only going to tell you what the balance in those accounts are. So this statement here is going to tell you what changed in those accounts from the last financial reporting cycle to this financial reporting cycle. And so specifically the things it's going to talk about is changes in the company's stock distribution. If you think about the shareholders' equity section of the balance sheet, it contains all of the company's stock on it. They're going to tell you about changes in other comprehensive income that have occurred during the period. If you're unfamiliar with other comprehensive income, these are essentially things that would otherwise be revenues and expenses, but because of the way they are treated and the nature of what they aren't recognized on the income statement yet. They will at some point, but not yet. And so for things that are essentially revenues and expenses that can't go on the income statement due to various rules or the nature of what's underlying them, they're going to get dropped into shareholders' equity as other comprehensive income. This is well beyond the scope of this video. So, if this is sounding like a foreign language to you, don't worry about it right now. I'm just letting you know it's on this statement. And then another big piece of the shareholders' equity section of the balance sheet is it shows the retained earnings of the company. Now, first of all, what exactly is a retained earning? Let's go ahead and establish that real quick, because you might not be familiar with that term, but it matters here. A retained earning is income that the company has earned, right? So think about it, retained earning. So they've earned it, and they have retained it within the company to fund future operations. Now you might be saying, well, wait a minute, if you earn it, of course you have it in the company. What's the alternative? Well, the alternative is to give it back to investors. Companies do have that option that when they make money, they can just give some of that money back to investors. But in case they don't, if they choose to keep the money to fund future operations, then that becomes part of what's known as retained earnings. And that is actually the more common thing than giving money back to investors. So when the company has retained earnings, income it has made in previous periods that it is holding on to, remember, that money belongs to the owners. It belongs to the investors. Therefore, it's part of the investors' wealth, and essentially it's part of the investors' investment in the company. It's their money that's just staying within the company. And so that shows up in shareholders' equity as well. Now, it's this piece right here, the changes in retained earnings. This is the piece that introductory students are expected to know. They're not expected to know the whole statement of shareholders' equity. And in fact, often textbooks don't even refer to the statement of shareholders' equity. What they refer to is the statement of retained earnings. But when you go looking in a real set of financials for the statement of retained earnings, you're going to have a hard time finding it, because it's really just a piece of this statement of shareholders' equity. And so I'm going to zoom in here for us over on our example on the right here, and notice retained earnings. And here we've got a calculation. What did you start with? The beginning balance. And how much more earnings did you make? Your net income. And how much did you give back to the investors? That's what's known as a dividend, when you give some of your income back to the investors. And then there's some other miscellaneous adjustments, and ultimately what you're left with, the ending balance. This piece of the statement of shareholders' equity, This piece is what textbooks tend to call the statement of retained earnings. And it really is just if you ignore the miscellaneous, because the miscellaneous won't apply to every company, if you ignore the miscellaneous, it's really a 4-line equation of how did the earnings that you're retaining change over time. And that equation, just to spell it out so it doesn't get lost in that example there, it's beginning retained earnings plus any new income you earned minus any what they call dividends, money you gave back to investors, equals your ending retained earnings. That's what's known as the statement of retained earnings from a textbook perspective, and that's the thing you're going to care about on the statement of shareholders' equity. All right, now notice here, and we're about to see it on the next slide, but notice a key component of this equation, net income. That should look really familiar because net income is actually the bottom line of the income statement. Now, notice I'm circling something that is not the quote-unquote bottom line of this screenshot, and that's because there's some additional calculations provided down here. But if we're looking at truly what is the income statement ends here. And that bottom line of that income statement is called net income. That net income, that's the netting of revenues and expenses. That's revenue minus expense. That is what the company earned. And notice that feeds into this statement of shareholders' equity in the retained earnings section. So this is your first link between the financial statements. The income statement, specifically the net income line, feeds into the statement of shareholders' equity for the retained earnings calculation. Two independent things that tell you something different about the company, but they're linked, right? And that's what I said. You have all these independent pieces of information, but they do link together. Next up, let's talk about the balance sheet. So, balance sheet reports the assets, the liabilities, and the equity of the company. Notice this one. This is really different. At a specific point in time, okay? So, assets is what the company owns. Liabilities are what the company owes. Equity is simply the net value of the company, represents the shareholder interest. And what the balance sheet tells you is literally what it sounds like. What is the balance of these accounts at a specific period of time, and at a specific point in time. And that point in time is usually the final day of the accounting period. So this is telling you not how did the company do during the period. That's the income statement's job. This is telling you when the period was over, what was the financial health of the company, right? How much did they own? How much did they owe? What was their net value at this point in time when the period ended? Okay? And you'll notice it's divided that way. If you look at our example on the left here, there's an asset section, then there's liabilities and shareholders' equity combined, but if you look, it is divided. There's the liability section, there's the shareholders' equity section. And this balance sheet helps establish what is known as the basic accounting equation, or sometimes referred to as the balance sheet equation. A equals L plus SE. Assets equals liability plus shareholders' equity. Now, it's always written that way, just because it's written in the positives, but it's a lot easier to understand if we simply convert this to SE equals A minus L. Shareholders' equity equals assets minus liabilities. In other words, the net value of the company, shareholders' equity, is equal to what the company owns minus what the company owes others. This also represents the investor interest because at the end of the day, investors are entitled to whatever that net value of the company is worth. So that's your basic accounting equation set up by the balance sheet. Notice again, we have our shareholders' equity section in here, but it's only telling us balances at a point in time. It's not telling us what changed during the period, which is why we need that statement of shareholders' equity we just talked about. That was telling us how it changed during the period. Now again, independent pieces of information all linked together. You might be guessing how this is linked. We had the statement of shareholders' equity, which had our retained earnings calculation in it. Well, when you're done calculating your retained earnings for the period, that ending balance you come up with, ending balance, that goes on the balance sheet. as of the point in time at the end of the period, right? So again, that's how those are linked together. Every statement is kind of feeding another statement as we go. Last up, we have our statement of cash flows. Our statement of cash flows is literally like it sounds. It is reporting the receipt and the expenditure of cash, again, for the period. So only the balance sheet was a point in time. Every other financial statement we've looked at so far has been for the period of time. Now, cash shows up on the balance sheet. If I back up real quick, balance sheet, remember, the first thing on here is assets, things you own. And the number one thing that you own that has value is cash. And if I zoom in, check out that very first line under current assets, cash and cash equivalents. And that's pretty much how every company is going to be. There's going to be cash right there at the first line of their balance sheet. But that only tells you about the balance in cash. It doesn't tell you how did cash change? Where did it go? Where did it come from? That's what our statement of cash flows is for. It tells you where did your cash go? Where did your cash come from? And specifically, it organizes it by type of business activity. Did cash come in or go out because you were raising it or paying it back? Did cash come in or go out because you were growing the framework of your business or tearing down the framework of your business? Did cash come in or out as a result of the core operating procedures that your business relies upon? This is very valuable to investors, not because it speaks to profit and loss. It doesn't speak to profit and loss. This is not revenue. This is not expense. It's just cash in, cash out. But remember, without cash, it's really difficult, if not impossible, to run a successful business. You have to have money in order to run a business. And so that's what makes this one so important, is it tells you exactly how the business is using or receiving cash. Once again, we can link this up. I told you that cash shows up on the balance sheet as an asset. And so, of course, if we compare, here's our balance sheet. Our balance sheet in this case had 2 years worth of cash on it. And our statement of cash flows starts off with beginning cash and ends with ending cash. Well, guess what? The cash balance at the end of last year, that's the starting cash for the statement of cash flows. The ending cash at the end of this year, that's the ending cash on the statement of cash flows. So the balance sheet cash numbers directly tied to the statement of cash flows. Now, you might be a little bit confused because you see this extra box I have down here with some extra detail. Sometimes you might see that the numbers between the balance sheet for cash and the statement of cash flows for cash don't exactly match. They're off by just a little. But if you look in the notes to the financial statements, you can often find the reason why. And in this case, that's what's going on. Here, Apple had reported cash and cash equivalents on its balance sheet. But on its statement of cash flows, it reported cash, cash equivalents, and restricted cash. So the statement of cash flows actually included an extra amount that wasn't on the balance sheet. But in the notes to the financials, there was a note that said restricted cash. And it showed you, here's what the other cash was per the balance sheet. Here's the additional restricted cash. Therefore, here is now the number that's going to be reported on the statement of cash flows. Okay, so the numbers will match, but sometimes you have to do a little digging to reconcile them if they're off by a little bit. But there's going to be a good reason, and it's going to be in the financials. You're going to find it. But again, two separate pieces of information. One is balance of cash, one is activity in cash, but they are linked together. Alrighty, so that was a lot, and that's just the overview, right? So financial statements get way more complicated, and I spend way more time in my in-class accounting lectures going into these topics than just what I did in this video. But this is to just introduce you to, hey, you've got this annual report. It's got all these components, but one of the most important components are these financial statements. And specifically, the 4 financial statements I showed you tell you a ton about a business. How it performed during the period, where its cash came from and went to during the period, did it retain its earnings from the period or give it back to another party, and what was the financial health at the end of the period. That is tons of useful information to make investment decisions off of. So hopefully you found this helpful. Please join me for the next video.